Welcome to Purdue Commercial AgCast, the Purdue University Center for Commercial Agriculture's podcast featuring farm management news and information. I'm your host, James Mintert, Emeritus Professor of Agricultural Economics at Purdue University. And joining me today is my colleague, Dr. Michael Langemeier, Director of the Center for Commercial Agriculture and Professor of Ag Economics here at Purdue. We're going to review the results from the April 2025 Purdue University CME Group Ag Economy Barometer survey of farmers from across the nation. Each month, we survey 400 farmers across the U.S. to learn more about their perspectives on the ag economy. This month's Ag Barometer survey was conducted from the 14th through the 21st of April. Michael, the barometer index rose 8 points to 148, and that leaves it just 4 points below the recent peak of 152 back in February. And I don't know about you, but I was a little bit surprised at the increase given what's taken place. Current condition index rose 9 points to 141. Again, that was a bit of a surprise. That's the highest current condition index since December of 2021. And the future expectation index rose 8 points to 152. And we've been kind of tracking the relationship between the index of future expectations and the index of current conditions. Future expectations is still higher than the current condition index, but that gap has really narrowed compared to last fall. Last fall, future expectations were much, much higher than current conditions. Now, they're still above by 9 points, but that gap has really narrowed quite a bit. So let's start off at the beginning. Michael, were you surprised that the barometer went up this month?
Given the answers to some of the other questions, I wasn't as surprised as I would be if we wouldn't have included the trade questions. For example, we're going to talk about this later on, but one of the trade questions essentially asked, do you think after the trade war, the tariff, imposition of the tariffs, agriculture is going to be better off in the long run? And over 2/3 said yes. And so I think that helps explain why the index of future expectations is still relatively high. I'm a little bit puzzled that the index of current conditions is as high as it is. One of the things we always have to keep in mind here is there is a fairly large percentage of folks here that are livestock producers, particularly cattle producers, and they are experiencing really good economic returns right now.
Yeah, that's a good point. I think every month, a minimum of 19% of the producers in the survey have a beef enterprise. The reality is we usually get more than that. In fact, we've been tracking in recent months, starting sometime last year, the exact percentage of people who have a livestock enterprise and what percentage of their gross farm income actually comes from the livestock side. So our survey is probably picking up a little stronger livestock influence from people that have multiple enterprises than you might expect. And that does help explain it a little bit. But you really didn't answer my question, Michael. You kind of cheated there a little bit because the first 5 questions on the survey are what are used to compute the barometer. And then the other questions come much later. So if you just looked at the barometer itself, were you surprised?
Yes.
Okay, there you go.
Yes. And particularly the index of current conditions. I did not expect that to increase. In fact, I expected that to drop a little bit. The sub-index is the one I was a little surprised at. Given how they answered some of those questions, the index of future expectations makes sense to me.
The one caveat to that, I guess, Michael, is I would say that cash prices for corn and soybeans have held up better than you might have expected, given some of the trade announcements.
That's definitely the case. And one other thing also that you had to keep in mind is there were some payments received because of the continuing resolution in December. And also, I think people are expecting some payments if these tariffs continue, some payments for compensation regarding the current trade policy. And so if you include the fact that livestock producers are doing fairly well, the crop prices have improved a little bit, and the fact that we're looking at some pretty sizable government payments in 25, maybe it makes more sense.
Yeah, I think all those factors kind of come together and kind of help explain what's going on. The Farm Financial Performance Index, it dropped a point, which is trivial in terms of any significance. So sitting at 101, that's still 11 points higher than it was back in October before the November election, 33 points higher than it was in September. And if you look at it on a chart, there's kind of a sideways pattern here. We've been basically above 100 going back to last fall, really in that October timeframe. So if you look at it, people are basically saying 2025 is going to be about the same as 2024.
And that's very consistent with my projections.
one of the surprises, at least to me, Michael, on this report was the Farm Capital Investment Index. It rose 7 points this month. That gives us the highest reading for the index since May of 2021. So the index reading was 61. If you go back a year ago, that index was at 31. 2 years ago, 43. 3 years ago, 36. So it's one of the highest readings we've had in quite some time. And that index really kind of hovered in that 30 to about 45 or 50 range for quite a period of time. So to see it at 61 seems, quite surprising, I think, with respect to strength. If you look underneath at the question that index is based on, which is thinking about large farm investments like buildings and machinery, do you think now is a good time or a bad time to buy such items? What's been driving the change has been, looking at it over the last year, for example, fewer people are reporting it's a bad time and more people are reporting it as a good time to make investments. So a year ago, only 11% of the survey said it was a good time to make large investments. This month, it was 25%. A year ago, 80% said it was a bad time to make large investments. This month, it was down to 64%. So the reason I'm a little surprised at this is, and you and I have been looking at this, if you look at what's taking place with respect to farm machinery sales, they have dropped hard, really 2 years in a row. They were down somewhat last year, but clearly down hard in this first quarter of 2025, according to the Association of Equipment Manufacturers. And yet our index was strengthening. So help me out here. See if you can explain this.
This one is very difficult, and I don't have a clear answer. But along with your tractor sales and your combine sales, another indicator here that does not match with what we're seeing is the Federal Reserve Bank of, I believe it's Kansas City, has a capital spending index that's really related to machinery and equipment. That thing has just been sinking. Now, they don't have the first quarter data in yet, but that thing has really dropped in the later part of 24. We'll see what the first quarter results look like for that index, but it's certainly inconsistent with what's been going on here.
Now, the follow-up is we do ask people what their plans for farm machinery purchases in the upcoming year compared to a year ago are, and that data is probably more supportive of what's taking place out there. So the percentage of people who say they plan to increase their purchases of farm machinery this year compared to last year has dipped. This month it was only 6%. If you go back a couple of months ago, it was at 10%. That percentage never seems to get very high. So maybe we're picking up something that's a little more consistent there. And then the other thing that you and I have been talking about is the way the index is constructed. You can get some small changes in that percentage of people who say they feel like it's a good time to make investments. And that can have maybe a little bit of an outsized influence on the index itself. Roughly 2/3 of the people in the survey this month still said it's a bad time to make large investments. And, one perspective is to say that group is really dominating what's taking place with respect to new machinery purchases.
Yeah, I think that's a good way to put it. When we ask people whether they buy used or new machinery, if you look at the average over the last several months, 70% buy used machinery.
Yeah. So one of the dilemmas we have with our index is when we ask people about making investments, are they thinking about used versus new?
Yeah, we don't distinguish.
Right. So there's some issues there. We're going to do some follow-up work and see if we can do a better job of figuring out what's going on there. And probably, I don't know about you, Michael, I think my perspective is we need to look harder at trying to figure out more information about the folks who say it's a good time to make investments. Yes. And see if we can figure out if they're actually doing things and what percentage of the market they really are. The short-term farmland value index was down 8 points compared to March, but that leaves it in that range of about 110 to 120, suggesting I would characterize it as cautious optimism about values, either increasing modestly or perhaps holding steady. And that's kind of important because the farm balance sheet is tied so heavily to farmland values. So that maybe correlates with some of the optimism we've picked up.
I definitely think so, particularly in the long run. Liquidity did slip in 24 compared to 23, but it's still not as low as what it was, like 15, 16, 17 and during that time period. And so liquidity's dropped, but it's not at a crisis point right now. But certainly the fact that farmland values are holding up is extremely important to the non-current portion of the balance sheet, and it's keeping those leverage ratios fairly low.
So we asked people about their biggest concerns for their farming operation the next year, and we've done that for quite some time now. And the chart that accompanies this podcast just goes back to September because I thought we'd look at what was taking place just before the election versus now. And not too much change across the board, Michael, except for one thing, and that is the availability of inputs. Going back to last fall, I think in September, only 3% of the people in the survey said that they were concerned about availability of inputs. That's tripled, more than tripled now to 10%. And before the podcast, you and I were talking about this. If you go back in the COVID timeframe, that's when people are most worried about availability of inputs. And they focused at that time, I think we got above 15% or so. So we're not back to where people were in the COVID era with respect to concerns about availability of inputs, but it's noticeable, right? People are starting to worry about this.
And I think those two are very closely related, like you said. I think those that probably answered availability of inputs is a big concern are also probably worried about increases in the prices paid index, which we did ask.
Yeah, that's good point. So that prices paid index, I think we told them in the question, increased by about 2% per year during the last 10 years. And we asked them, using that as a frame of reference, by how much do you expect farm input prices to change during the next 12 months? And, it's really kind of interesting. I mean, the majority, 63%, said 0 to 4%, which would be fairly consistent with that 2% from the last 10 years. But 29% said 4 to 8%. And if you look at it from there going up, I think, 36% of the people in the survey think farm input prices could increase by 4% or more over the next 12 months. Those are some big increases.
They definitely are some big increases, and there hasn't been that many years in the last 10, maybe one or two, right after COVID there where prices increased over 5%.
Yeah, and going back to our previous question, the number one concern, and has been really for quite some time, has been high input cost. Yeah. 38% shows that as their top concern. So, why are they worried about that? Well, that fact that 36% think the input prices could increase by 4% or more in the next 12 months kind of explains it.
And really, when you dig under the hood, looking at the items that are included in the prices paid, it's not consistent by any stretch of the imagination. I just updated some information looking at year-to-year changes in some of the items in the prices paid for farm inputs for an article I'm working on. And there is items that are just almost flat. There's almost no increase. The big one in prices paid that increased, which we don't always think about because we talk a lot about crop producers in this survey, is the price of purchased livestock. So that's driving up the prices paid index because it's such a important component of that. And the actual prices paid index that includes all the items used in production agriculture actually increased 6% year to year.
So, Michael, when you look at it, for example, the crop budgets, what kind of crop budget increase are you showing?
They're very flat.
With 2024.
With 24. Because a lot of the inputs that are crop related are either up slightly or down slightly. The exception there is diesel is down substantially. And some of the fertilizers, the potash in particular, is down from what it was a year ago. And so when you put all that pieces together, they're pretty flat.
Okay. We asked people about their expectations for interest rates, and we gave them a little bit of background. The U.S. prime interest rate is currently 7.5%. What do you expect prime interest rate to be 1 year from now? 70% of producers said that they look for interest rates to remain either unchanged or head lower. Roughly 1 out of 5, 19% of them said they think rates will be higher a year from now. So that's probably consistent with what the Fed has been saying, although we've gotten more uncertainty with tariffs, and certainly the tariff battle between the president and Jerome Powell at the Fed has been kind of interesting. But
yeah, I was thinking about how I would answer this question. I probably would go with no change, because you have some factors that would think that maybe interest rates are going to lower, but on the other hand, you have some factors that you might see higher interest rates. And so, yeah, like you said, there's just a lot of uncertainty with regard to where monetary policy is going.
Yeah, the dilemma for the Fed is going to be, what is the impact of tariffs going to be on cost, and what does that do to inflation, and in turn, what does that mean for monetary policy? So we asked people, what impact do you expect the U.S. government's imposition of tariffs on imports will have on your farm's income in 2025? And, we asked this, I think, a month ago, and so we repeated it. This month, 56% think tariffs will either reduce their farm's income in reduce their farm's income in 25. If you say no impact and add that, then you're up to 78%. 21% say they think it'll actually be positive, and we're a little puzzled by that, right?
Yeah, I'm very puzzled with that statement.
You're not going to go beyond that.
No, I'm not going to go beyond that. I just don't see that. But
I was thinking about it, and we don't attempt to survey specialty crop producers, but we do pick up some people that produce specialty crops. And that's probably one of the few areas where I could potentially see some positive impact coming about from tariffs with respect to restricting imports and maybe having a positive impact.
yeah, I think you're right. When I think about tariffs, I'm usually thinking corn, soybeans, and wheat.
So
and it's hard to paint a picture where that's going to be positive for corn, soybeans, and wheat.
And our survey targets the major commodities. It doesn't try to target people who are specialty crop producers. We do pick up some of those folks because they also produce the major commodities. So, but that's not large enough to account for the 21%. So that's an interesting response. Next question was, if a trade war leads to lower prices for U.S. ag products, how likely do you think it is that farmers will receive compensation similar to 2019's market facilitation program? And again, we asked this previously. This month, 80% of the producers think a program similar to the 2019 MFP will help compensate their losses that might recur as a result of the trade war. That's up. I believe the last time we asked that last month was closer to 70%. So more people are more confident that they're going to get compensated. I think that's probably feeding right back into that current condition index.
Definitely. It's definitely increasing the index of current conditions.
We asked people, how important is it that a new farm bill be passed in 2025? 72% said it was either important or very important. Again, that's up from previous times. We've been asking this question off and on. That's, I think, the highest percentage we've ever gotten to say important or very important.
Which is not surprising to me, because the way I talk about this issue when I'm asked by reporters is, just think of it this way. You've got uncertainty related to trade policy, you've got uncertainty related to monetary policy, and you add to that we don't have a farm bill passed. Of course people want the farm bill passed, so we have a little bit of knowledge or information about where that safety net's going to be.
Yeah, I think that's exactly what's going on, and people are really starting to focus on that. So one of the questions we asked was, do you expect to have some difficulty in obtaining inputs for your farm operation in 2025 as a result of tariffs? And just over half, I think 53% of the people in the survey, so kind of a coin toss almost, said that they thought they would have some difficulty. And if you said that you were expected to have some difficulty obtaining inputs this year, the follow-up question went to that group, so it went to just over half the people in the survey. And we said, what do you expect to have trouble with? Number one was fertilizer at 37%. Number two, and really a kind of a tie really, was parts for farm machinery and electronics and crop chemicals. Chosen, I think in the case of parts for farm machinery and electronics, was 27%. Crop chemicals is 26%, so no real difference there. People weren't worried about new farm machinery, only 3% chose that, and then there was the other category of 7%. So fertilizer is concern. That's largely, I think, related to Canada, and you mentioned potash.
Yeah.
So far, hasn't had a positive impact on prices.
But it could.
But it could. People are worried about it. And then the parts issue is clearly out there, and chemicals, because we do import a fair number of crop chemicals as well. So there is some concern out there, and I think that reflected also in the previous question where we asked them about top concerns, and 10% said they were worried about inputs. So finally, I think our last question, kind of to wrap up the survey, was, do you expect the increased use of tariffs by the U.S. to strengthen or weaken the U.S. ag economy in the long run? I think this is the first time we asked this particular question. 70% said they think in the long run it will strengthen the U.S. ag economy. I'm going to let you comment on that.
I was very surprised that it was 70%. I would have thought that it might be 50%, but 70% was very surprising to me. And I think if you asked ag economists this same question, I think it would be flipped, that 70% or a large percentage would say it's going to weaken. And one of the reasons that economists would say that is when you have trade disputes like we're currently having, you worry about your long-run market share. It's not only do we drop this market share temporarily, how do you get it back? It's not, once you've lost market share, it's not that easy to get it back. And that's the big concern I have, is that we're going to permanently lose some market share, particularly to China.
Yeah, in terms of our share of China's imports, and losing market share probably to Brazil, right?
Yes.
You said flipped for Ag Economist. Based on the economists that I've had a chance to visit with, I don't know anyone who actually would choose strengthen. So this is a very curious result. I like you, I was surprised at the actual percentage of 70%. I was not surprised it was a significant positive, because you could pick that up from comments people were making at various press outlets and various meetings and so forth. So, but yeah, again, I think it also explains why the future expectation index is as strong as it is.
Definitely. I think it's extremely important in explaining that index of future expectation.
Yeah.
Because if you didn't think this, that index of that the future would not look near as rosy, obviously.
Yeah. So that wraps up the highlights of this month's survey. You can get the full report on the Purdue CME Group Ag Economy Barometer website, which is purdue.edu/Ag Barometer. Of course, you can listen to this podcast not only for the Ag Barometer updates periodically, but also a wide variety of topics, which you can subscribe to on all the major podcast providers as well as on the website. So on behalf of my colleague, Dr. Michael Langemeier and the Center for Commercial Agriculture, I'm James Mintert. Thanks for joining us.